So while the Reserve Bank of Australia is leading this really painful rate hike that's just hammering Australian homeowners,
Yeah, it's brutal.
at the exact same time, you have Brazil emerging as this huge safe haven
Yeah.
for investors who are, fleeing the American market.
Right.
And it feels totally random, maybe unfair, but it's not a coincidence. It's a direct transfer of wealth.
It is. It's the global financial plumbing in action. And, well, unfortunately, most people are just on the wrong end of the pipe.
Exactly. So welcome back to the deep dive. Today we're digging into a stack of research that is honestly, it's a bit terrifying, but you absolutely need to know this stuff.
Hmm?
We're connecting a policy decision made in Canberra, literally, directly to your bank account. And then we're going to trace that money all the way to South America.
And just to be clear, the insights we're going through, these aren't just headlines we, grabbed off a newsfeed. This is all curated by former institutional strategists. They use AI-accelerated analysis, but with, human judgment layered on top. This is serious high-level stuff.
Right. So let's get into it. The first report is called Carrying the Cost. And it kicks off with this metaphor that I love how clear it is, even if I hate what it means for my wallet.
Uh-huh.
The fire extinguisher versus the rain dance.
It's a really vivid image, isn't it? It just perfectly describes the huge policy split we're seeing right now.
Okay, so break that down.
So on the one side, you've got the RBA, the Reserve Bank of Australia.
Right?
They're holding the fire extinguisher. They are just aggressively hiking rates, up to 3.85% to put out the inflation fire.
They're being active. They're spraying foam everywhere.
Exactly. And then you look next door to New Zealand.
The rain dance.
Right? The Reserve Bank of New Zealand, the RBNZ, they're doing the rain dance. They're keeping their rates much lower, down at 2.25%.
So they're not actively fighting the fire. They're just kind of
Yeah,
waiting for the weather to change.
they are. They're waiting for outside factors to solve the problem for them.
Okay, so Australia's at 3.85% and New Zealand is at 2.25%. That is a huge gap.
Oh, it's a 160 basis point gap. In the world of global finance, that's not a gap, it's an ocean.
Oh, okay. But before we get into the whole global game, let's bring it back to the kitchen table.
Yeah.
Because 3.85% sounds like an abstract number.
Sure.
But the report does some math that really hits hard. It shows what that last 25 basis point hike from the RBA actually costs a family.
And this is where the Australian market is just unique and, well, uniquely painful.
How so?
Unlike in the U.S., say, where you might fix your mortgage for 30 years, something like 90% of Australian home loans are on variable rates.
So when the RBA makes a move, your banking app updates almost instantly.
Precisely. The transmission is immediate. And the math in the report, it shows that for the average Aussie mortgage holder, this one specific hike works out to be about an extra $90 a month.
$90, which, doesn't sound like the end of the world until you start looking at it over a year.
Right. That's roughly $1,080 per year.
Just gone.
Just gone. Vanish from your disposable income. And you have to remember, that's after-tax money you have to find just to keep the roof over your head.
And that's just from one hike? That's the price of the RBA picking up its fire extinguisher?
Mm.
But this is where it gets really, really interesting. That money, that $1,080, it doesn't just disappear.
No.
It goes somewhere.
It absolutely does. And that brings us to the engine that drives this whole thing, the global carry trade.
Okay, carry trade. We hear this term on the news all the time, usually followed by a bunch of confusing charts. Let's just break it down. What's actually happening?
If you strip away all the jargon, it's actually really simple. It's just arbitrage.
Okay.
So investors, they look at that ocean of a gap we just talked about. New Zealand has cheap money at 2.25%. Australia is paying a lot more at 3.85%.
So what do?
You borrow a ton of money in New Zealand, where it costs you less, and you move it straight over to Australia to earn that higher interest rate.
You're just literally moving cash to where it gets treated better?
That's all it is. But when billions of dollars do that all at once, it moves the entire market.
Right.
The institutional data in our source, from JP Morgan, it suggests this pressure is going to push the Australian dollar, the AUD, up pretty significantly against the US dollar. They're forecasting it could hit 0.73.
So the Aussie dollar gets stronger because all this global money wants to buy it to get that higher interest rate.
Correct. But, and this is really the crucial part, the money doesn't just stop there. It doesn't sit in an Australian savings account.
Okay.
The global financial system is always hungry for more yield. Australia is just the first stop on the train. The capital that comes into Australia is often reallocated almost immediately to even higher yielding emerging markets.
And here's what nobody's telling you about this move.
Hmm.
Australia is like the gateway drug for global capital right now.
That's a great way to put it.
The money flows in, it pumps up the currency, but the really smart money is already looking for an even bigger payoff somewhere else. And the report, it names the destination. The land of Samba and massive capital inflows.
Massive is the right word. The estimates for 2026 are showing potential inflows of US $26.3 billion.
Billion with a B. That is a staggering amount of money. Why Brazil?
It's what they call the risk-off paradox. Usually when investors get scared, and there's a lot of volatility in the U.S. markets to be scared of right now.
They run to cash, U.S. dollar.
Right, but because inflation is still so sticky, cash is losing value, so they need high yield. But in a place that's kind of detached from the whole U.S. mess, Brazil offers incredibly high interest rates.
So as the U.S. dollar weakens, the the BRL, it strengthens.
Exactly. So the money borrows in New Zealand, makes a quick stop in Australia to push up the AUD, and then it floods into Brazil to capture those, double-digit yields.
And the numbers back this up.
Completely.
Yeah.
The performance metrics show that emerging market interest rate portfolios hit an 18% gain in 2025.
18%.
18. So while the Australian homeowner is paying an extra $1,080 a year, the global investor who gets this flow is making an 18% return.
That is infuriating. But also, I guess, incredibly efficient.
It is ruthlessly efficient.
But I want to go back to this idea of a hidden tax. Because the report does something here that it blew my mind. It connects these two completely separate things.
The Aussie mortgage and the Brazilian bond market.
Yeah. And it does it with a calculation that feels almost like a conspiracy theory, but it's just math.
The real story isn't the index move, it's what happened under the hood. The report calls it the translation of data. It's, a storytelling device, but the numbers are just startlingly close.
Okay, walk us through it.
All right, so you take that massive figure we just mentioned, US $26.3 billion in foreign money flowing into Brazil.
Okay, that's the global gain side of the equation.
Correct. Now, you look at the local pain side, there are approximately 26 million households in Australia.
Okay.
If you divide that US $26.3 billion inflow by those 26 million Australian households, what do you get?
I'm scared to ask.
You get roughly US $1,011 per household.
Wait a minute. The mortgage hike cost we calculated right at the start
Was roughly $1,080 per year.
No way. They're basically the same number.
It is essentially a one-to-one ratio. So mathematically, the extra money leaving the collective bank accounts of Australian homeowners is equivalent to the capital that's fueling the Brazilian market boom.
So not literally, but metaphorically speaking. My mortgage pain is funding Brazil's party.
That is the aha moment of
Yeah.
the report. It's a perfect illustration of a global transfer of wealth. The RBA fights inflation, you pay the price, that capital looks for yield, and it ends up funding a project in Sao Paulo.
You are the source, they are the destination.
Yep.
I mean, that makes me feel very small and very, very used.
It's just the nature of the beast. But knowing about it is the first step to not being a victim of it.
This creates a serious problem for your monthly budget, and here's why it matters to you. We can't just sit here and complain about the system.
No.
We have to do something. So the report moves from the shock to actionable adjustments. How do we stop the bleeding?
Well, the first step is always defense. You stop the bleeding. And the data shows that Australian borrowers are already doing this. About 35% of them are planning to lock in fixed rates in 2026.
That makes total sense.
Yeah.
If the RBA is holding the fire extinguisher, you don't want to be standing in the fire. You lock in your rate, you cap your downside risk.
Exactly. It's simple, it's not exciting, but it works. But the report argues you can't just play defense. You have to go on offense. You need to hedge.
Meaning, if the system is designed to move money from point A to point B, I should probably have some of my money at point B.
Precisely. If we know this carry trade is pushing the Australian dollar up towards that 0.73 target, and we know the capital is flowing into Brazil and strengthening the real, you can position yourself to actually profit from that exact flow.
So instead of just taking the hit on the mortgage, you use other financial tools to catch some of the upside. What are we talking about here? Buying Brazilian bonds. That sounds really complicated for a regular person.
It can be. The report suggests a more accessible way is using CFDs contracts for difference. They let you get exposure to currency movements without, buying a plane ticket to Rio and opening a foreign bank account.
Okay, but we have to put a massive flashing warning sign here. CFDs are not a simple savings account.
Absolutely. This is crucial, and the report is very clear about it. You must use ASIC-regulated brokers. That's the Australian Securities and Investments Commission.
You need that safety net, that transparency.
The wild west of crypto exchanges or some unregulated forex broker is not where you want to be for this.
And CFDs are high risk. I mean, you can lose more than you put in if you don't know what you're doing.
Correct. This is all about understanding volatility, but the logic is clear. You can go long AUD, which is just betting on it to rise towards that 0.73 target, and you can get exposure to the BRL, the Brazilian real, to capture the upside of that carry trade flow.
So the two-part strategy is, 1, fix your mortgage to stop the cost from spiraling, and 2, use a small bit of capital to bet on the currencies that are benefiting from the very rate hikes that are hurting you.
You're essentially hedging your own life. You're hedging your mortgage.
That is a really fascinating way to look at it. Instead of just being the victim of the macroeconomy, you're participating in it.
It completely changes your psychological relationship with the news. When you hear RBA hikes rates, instead of just that sinking feeling of, oh no, my payment's going up, you also think, okay, my AUD long position just got a little stronger.
It doesn't cancel out the cost, but it softens the blow.
It mitigates the sting.
I want to just circle back to Brazil for a second, because US $26.3 billion is a huge number. The report mentions the Brazilian real strengthens when the US dollar weakens. We're seeing some of that now, aren't we?
We are, and that's like pouring fuel on the fire. When the USD weakens, emerging markets almost always rally. Investors are looking for growth, and right now the US has its own fiscal problems, debt ceilings, political drama.
So Brazil, weirdly, looks like the stable, high-yield alternative.
It's amazing how fast that narrative can change, right? A few years ago, Brazil was the capital of volatility. Now it's the safe haven.
A high enough yield covers a lot of problems.
It really does. When you can get double-digit returns on government debt, the market tends to forgive a lot of political noise. And these inflows we're seeing, they create a self-fulfilling prophecy. The money comes in, the currency gets stronger, inflation cools down, and the assets do well, which just attracts more money.
Until the music stops.
Until the music stops. And that's why we watch the flows. But for 2026, the direction of the flow is crystal clear. It's out of low-yield places like New Zealand, through the strengthening AUD, and into the high-yield embrace of Brazil.
And the RBA, I mean, they're just focused on their domestic inflation number. They don't care about the Brazil flow.
They can't afford to. Their job is domestic price stability. If achieving that crushes the household budget and sends capital flying overseas, well, that's just collateral damage.
The fire extinguisher doesn't care if it ruins the furniture.
As long as the fire goes out.
That is a depressing but very accurate analogy. Okay, so let's just summarize the whole chain here, because there are a few moving parts.
Sure. So, step 1, the RBA fights the inflation fire, hiking rates up to 3.85%.
Yep. Step 2, your mortgage goes up about $90 a month or $1,080 a year for the average household.
Ouch. Step 3, that rate difference attracts global money. It leaves New Zealand, floods into Australia, and pushes the AU-DUSD pair up towards 0.73.
And then step 4.
The smart money keeps moving. It goes on to Brazil to chase even higher yields, strengthening the BRL and generating those 18% portfolio gains we talked about.
And the really wild part is that the amount of money leaving your pocket is mathematically almost identical to the amount of money flowing into Brazil on a per-household basis.
It's a closed loop of pain and gain.
The circle of financial life.
Just not the version Disney told us about.
Definitely not. And I think the biggest takeaway for everyone listening is that you don't have to just sit there and take it. You can lock in your rates. You can look at regulated brokers to hedge with currencies. You can stop being just the payer in this equation.
Knowledge is really the only hedge that doesn't cost you anything. Just understanding why your mortgage is going up makes it so much easier to handle than just feeling like the world is against you.
Right.
The world isn't against you, it's just indifferent. It follows the yield.
The world follows the yield. That should be on a t-shirt. Or maybe a tombstone for my bank account.
Let's hope for the t-shirt.
Before we sign off, I just want to leave everyone with a final thought. We've talked about how efficient this system is, how fast this money moves.
Milliseconds.
So here's the question. If the global financial system is efficient enough to move capital from your mortgage to a Brazilian bond in the blink of an eye, are you positioning yourself to be the toll booth, or are you the traffic? Because right now, most of us are the traffic, and we're getting run over.
That is the question. You want to be the one collecting the toll, or at least driving the car.
Not the roadkill.
A bit graphic, but yes, point taken. Not the roadkill.
It's a scary picture, but a necessary one to see. Thank you for connecting all these dots today.
Always a pleasure.
And to you listening, please check the show notes. We've linked the sources. You can actually check the math yourself, especially that $1,011 Brazil calculation. It's really wild. Until next time, keep your head up and your rates fixed.
Stay safe out there.